Welcome to today's video. In this video, we're going to be discussing about investment in property versus shares. Which one is better for you? So last time I talked about how to save money for emergencies, a crucial first step in financial stability. You can find this video in my playlist, and as you can see, that's the thumbnail for the video. But once your emergency fund is ready, that's what we were talking about in the last video. And the next big question is, what now? How do you grow your money? That's exactly what we are diving into today. Investing. So there are so many options out there for investing, but in this video we're going to be discussing about property and shares investment. We are going deeper because being smart with your money means understanding the full picture, the risks, the rewards, and the mindsets and the options. Slide. If you enjoy this content, please subscribe. I spend a lot of time to make these videos and do research on the topics, and also writing scripts that are clear, learning new softwares and making visuals that help explain everything. Your subscriptions tell me that my efforts matters. It motivates me to keep making videos that keep us motivated on our growth journey. So if this helps, please hit that subscribe button. It means a lot. Now let's jump into our other slide. That is, so saving money is safe, but over time inflation is gonna eat your money basically. It's not gonna help you a lot. If you're just keeping your money in your bank, that's not gonna take you any further. That's why investing is important. It's how you build your wealth. Here are some of the types of investment options available in the market. Starting a business, buying index funds, investing in bonds, real estate, ETFs, exchange trade funds, gold and silver. While you can buy gold and not the real gold and silver, you can also buy online with the bank. And even investing in your own education matters. The key is understanding the balance between risk and reward. Now, property is one of the most popular and trusted forms of investments around in the world. It's something physical, something you can see, you can touch, live in, or rent out. Many people love property because it feels safe, it's real, unlike digital assets or stocks. But to really understand how it works, let's break it down. Let's say you have bought a house worth 600,000. You put in 20% deposit, which is $120,000. The remaining $100,000 is borrowed from the bank. This is your mortgage. A few years later, the house prices increases in value to $750,000, let's say. That means you have made a capital gain of $150,000 on your $120,000 investment. This is a 125% return, not on the entire house, but on the deposit you put in. This happens because of leverage, a powerful concept in property investment. You are using someone else's money, the bank money basically, to make more money. Leverage explained simply: imagine buying a chocolate bar for $1 and selling it for $2. That's 100% profit. Now imagine you only paid 20 cents of your own money and borrowed the other 80 cents. If you still sold the chocolate for $2, your return is much higher on that 20 cents. That's leverage. It multiplies your gains, but be careful, it can also multiply your losses. Now let's look at both sides of the coin. benefits of property investments include appreciation. Over the long term, property tends to rise in value, especially in growing cities and popular suburbs. Historical trends in many markets shows consistent growth over decades. Rental income is another benefit. If you rent it out, you get regular income which can help cover your mortgage rates and other expenses. Over time, rents often increases. Equity equity growth is also a key advantage. As you repay your mortgage and the property value rises, you build equity which you can then use to borrow for another property or other investment. Tax benefits play a role too. In many countries, investors can claim deductions on loan interest, property management fees, repairs, insurance, and depreciation. You also get control and flexibility. You have the power to improve the property through renovation, subdivision, or changing how it's used, all of which can increase both rental income and capital value. Lastly, property can act as a hedge against inflation. As inflation rises, so do rents and property values, meaning your investment keeps up with the cost of living. However, there are challenges and risks to consider. Property usually requires a high entry cost, often 10 to 20% of the purchase price, which would be 60,000 to 120,000 for a 600,000 home. Then there are upfront and hidden costs such as lawyer fees, building inspections, loan applications, limb reports. In New Zealand, you need to get limb reports, and government duties like stamp duty if applicable. Sometimes people forget about these extra costs. Ongoing expenses also come into play. You'll need to pay property rates, insurance, maintenance, and possibly body corporate fees. If it's an apartment, you might also have to pay to move into the property itself. Plus, if you're using a property manager, then they will take a percentage of the rent. There's also vacancy and the tenants. There might be times when your property is empty, meaning no rental income, or you may face issues with difficult tenants. Market volatility is a factor too. Property values can fall due to economic downturns, oversupply in the area, interest rate hike, or regional job losses. Speaking of which, interest rates themselves are a risk. If rates rise, your mortgage payment increase, potentially affecting your cash flow. And of course, property is liquid. It is, I mean, it isn't easy to sell quickly. If you need to exit fast, it could take weeks or months to find a buyer, especially in a slow market. Sometimes it can be extended up to an year. When it comes to positive cash flow versus negative gearing, a positive cash flow property brings in more rental income than expenses, meaning it pays for itself and gives you profit. A negatively geared property costs more than it earns, but you might claim losses on tax. Both strategies are common, but you need to know how your numbers gonna be. Property is the best form of investment. Who are comfortable with long-term commitments, understand the responsibility of homeownership or being a landlord, and have the financial stability to manage debt, repairs, and emergencies. It's deal. If you want something tangible, are you okay with waiting years to see growth and want to build equity and income over the time? So that's what I think about property. Now let's talk about shares and managed funds, a more accessible investment path for many people. Unlike property, shares don't require large deposits or dealing with banks. You can start small, be flexible, and still grow your wealth steadily over time. When you buy a share, you are buying a small piece of a company. If the company grows and becomes more profitable over time, the value of your shares increases. Some companies also pay dividends, which is like sharing the profit with shareholders. There are different types of investment you can start with. Individual stock let you choose companies yourself, like Apple, Tesla, Fisher and Paykel and or Air New Zealand. ETFs, exchange traded funds, are bundles of many companies in one share. For example, the S&P 500 ETF includes the 500 largest companies in the US, which spread risk around multiple companies. Managed funds are another option. A professional investor manages your money and chooses where to invest it. This is great if you don't have time to research company. Dividend stocks are companies that regularly pay out profits as dividends, providing income even if you don't sell the shares. Growth stocks are companies that reinvest profits to grow bigger. They don't usually pay you dividends, but their share prices can rise significantly over the time. Shares offer many advantages. They have a lower barrier to entry. You can start with just a few dollars, which is perfect if you are still building savings. Liquidity is another plus point. You can sell your shares anytime during the market hours and the money is back in your account within days, sometimes in less than 8 to 10 hours. You can also diversify your investments across countries, sectors, and industries to reduce risk. Reinvestment of dividends or profits can help accelerate your growth. Many platforms now allow automatic weekly or monthly reinvesting. You can set it and forget about it. Over time, compound growth for reinvestment earnings builds wealth exponentially, especially if you start young. Of course, there's a risk to keep in mind. Share prices can be volatile, going up and down daily. That's normal, but it can be emotionally difficult for some people. There are no guarantees. Unlike savings, your capital is protected. If the company does poorly, your share lose value. Timing is also a risk. If you need money urgently and the market is down, you may have to sell at loss. If you're picking individual stocks, research is required. You need to understand financial reports, industry trends, and business models. Emotional investment is another danger. Panic selling or chasing trends can lead to bad decisions. Long-term patience is a key when you are investing in the shares. Historically, global stock markets return around 7 to 10% per year, better than most of the saving accounts or term deposits. But these are long-term averages. In any single year, return can be much higher or lower. Shares and funds are ideal for people who are just getting started, want to invest small amount regularly, and prefer a hands-off, low-maintenance approach. They also suit people who want flexibility, fast access to their money, and the ability to spread the investment across multiple areas. So that was all about shares. Now this is where it gets personal. Your decision depends on your life stage, income, savings, goals, and how much risk you are comfortable to take with. Younger people may be more willing to take on high growth, high risk investments. Older investors might prefer stability. If you don't have enough for a property deposit, shares may be more accessible. If you want tangible assets or long-term capital gains, property might suit you better. Ask yourself, am I okay with digital investment, or do I prefer something physical like a house? Can I afford a mortgage and ongoing costs? Will I panic if my investment drops temporarily? How long do I plan to invest? 5 years or 20? Do I want passive income or just growth? There's no universal better option, just what's better for you based on your current situation. Now, whether you are in your 20s, 30s, or 50s, the best time to invest is when you are ready, financially and emotionally. Start small, stay consistent, and don't panic when the market dips. Long-term investing is all about patience, discipline, and staying committed through the highs and lows. So you don't need to be rich, to be honest. Investing is a key. Even $20 to $100 is enough to begin your journey. The key is consistency. Learn the basics, understand the risk, and don't hesitate to get professionals' advice if needed. Wealth is not about luck, it's about making small, smart decisions over time and sticking to them. Your task for today, when you're watching this video, and if you're still here until now watching this video, that's amazing. Thank you so much. Now the task is take a moment and reflect which type of investment suits your current goal, risk, and budget. Do some basic research on at least one investment type mentioned today, whether it's shares, property, gold, or managed fund. Then share your choice in the comments section and tell why you picked it. Let's learn from each other and grow as a community. Now, if this video gave you clarity, please give it a thumbs up and share it with your friends. Someone who is unsure what to do with their savings, and don't forget to subscribe to this channel. I have got more videos coming soon, and I'm really working hard to provide good valued videos on this channel, so make sure you subscribe to this channel to help me grow. See you next time in the next one.